Louise?
Yes, thank you, Alan. I appreciate it. And thank you, Steve. I really appreciate your time today. I know how busy you are, and it's an honor to have you here with us today. I'm Louise Dawson. I am the restaurant program manager for the NorCal SBDC. I run the restaurant program. I have 30 years of experience in the industry. I've had 2 restaurants and a large catering company, mostly specializing in the movie industry. I began my advising with the San Francisco SBDC back in 2005. Around that time, I started to realize how many of my clients through the SBDC and my direct clients were having issues with their leases and kind of struggling through issues with their landlords. And so I decided that I needed to learn that so that I could help my clients. And I have been active in the real estate world for about 15 years now. I'm currently a partner at Vandermeid Commercial, which is a boutique commercial real estate company in San Francisco, and I specialize in restaurants, bars, and nightclubs in San Francisco, Oakland, and Berkeley. And I'm very specialized, so I don't sell gas stations. I just do hospitality. And from there, I'm going to pass it over to Steve. He comes from a little bit of a different perspective. So welcome, Steve, and thanks again for joining us today.
Sure. Yeah, thanks, Louise. Thanks for having me. I started in the restaurant business when I was 15. I got involved in the family business. I started washing dishes while I was going to high school part-time, and through the years. Then I jumped in the kitchen, and learned the back of the house. And then I got a couple of college degrees. I had a stint in the service. I actually was in food service in the service. I was a mess sergeant of a mess hall, which served 500 airmen a day. So I got a different perspective of food service experience. So after graduating from college, I came into the family business full-time as a manager trainee. Then I became an assistant manager and then a manager, and I opened about 10 different restaurants. Then became an area supervisor, and then the vice president, and then president, CEO of the company. There's a little nepotism though, because my father owned the company. But in any case, I had to pay my dues. So I had about 20 years of actual operational experience in the business, and decided that running restaurants really wasn't going to be my forte from my total career. I thought maybe selling restaurants may be an interesting opportunity, since I also have a commercial real estate background. I got involved in buying small pieces of commercial real estate when I got out of college, and subsequently became a syndicator for a part of my career. And so I have a pretty good grasp on commercial real estate. I'm a restaurant landlord, hotel landlord, involved in various other investment properties. So anyway, I started Restaurant Realty in 1996. I was a sole practitioner for about the first 6-7 years, and I got my first assistant, and then I got a couple other assistants, and then had my first selling agent join me about 2008, and then in 2013 had another agent join me, and then we also decided we would expand to Southern California. So at this point, we represent the whole state. We do transactions throughout California. We do restaurants, bars, clubs, and related commercial buildings. So that's sort of my background.
Thanks. Is it just me having a bit of a hard time hearing Steve? I'm hearing a little reverb on your microphone.
Okay, let me see if I can turn the volume up.
I don't know if it needs to be turned.
Okay, let's see.
Maybe put more space between you and your microphone, maybe a little bit.
Yeah, okay, let me try it.
So okay. The agenda for today, and again, we have a lot of information to cover, and I'm not 100% sure we're going to get through it all. Alan's going to try and keep us on track, but we're already about 8 minutes behind. So I'm going to move as fast as I can. Both Steve and I are willing to stay on past the 90-minute mark. If any of you have to jump off because you've got other appointments, it's okay. We are recording this, and everybody that attended today is going to get a copy of the recording. So if you put your question up in the Q&A, even if you're not there, we'll try to go ahead and answer it for you. We'll do the best we can, but there's a ton of info. So I'm going to go through this really quick. So the first section, we're going to talk about getting prepared for selling a restaurant, a little bit about valuation, the process of purchasing and selling a business opportunity, and some fine negotiation points. Section 2, we're going to talk more about the lease side, acquiring a lease, the types of acquisitions, the qualifying or approval process with the landlord, and more negotiation points as they relate to the lease. Section 3, we're going to talk a little bit about location, location size, choosing a location, a few other considerations such as zoning and occupancy, what can you afford, and special equipment. I'm going to ask you a question in a little bit, and if there's a lot of you that are here interested in selling your restaurants, then what I'm going to do is section 4 first, and then I'll do section 3. Right, so I'll flip the last 2 just to make sure that those are here actually get the information they need. We're going to be covering exit strategy, when and how do I sell, lease and industry cycle. The best exit strategy is always to purchase the real estate, and exit strategy now in COVID and what to expect. So by the end of the course, you'll have you'll be able to establish when you're ready to begin looking for a location or selling a location, understanding the process of buying a restaurant, the valuation, negotiation points, leases, and exit strategies. So before we begin, how many of you are here today because you're either interested in buying or selling or other? Other would be, I'm a broker and I'm an SBDC advisor. So write in the chat for me, are you looking to buy? Are you looking to sell? Or are you other? Okay, I've got, it's pretty even between buying and selling, although I think there's a few more buyers than sellers here. Okay, so
yeah, that's kind of what it's looking like for me. I'm thinking it's probably more by maybe 50% buyers, 40% sellers, and 10% others.
Yeah, so that's really interesting. Well, thank you for responding. That gives us a great idea on how to kind of frame the information today. So let's jump right into section 1, purchasing and selling a restaurant. And I'll tackle this first slide. I'll go ahead and start. So for the buyer, are you ready? Do you have your business plan and your financials ready? You know, writing a business plan is always step 1 for any startup business. It helps you to work through your concept and through the marketing and demographics, and essentially hold your product up to the light to see if there are customers who are willing to, you know, purchase your product. It teaches you a lot about your customers and how to reach them. So for this webinar, it also helps you to decide on criteria for a space, and through the financials to decide how much you can afford. My clients that begin with business plans are usually a lot more successful and have more longevity than those who don't. And furthermore, investors, if you're going the investor route, bankers, if you're going the loan route, and most landlords will all ask for copies of your plan because they want to see, you know, what your concept is. So that's first. Do you have your business plan and your financials complete? If you don't and you need help, the SBDC is here to help you with that. Have you checked your credit lately? You know, have you, the first thing the bankers and some landlords are going to ask for copies of your credit. scores. So have you checked that? Do you need to, from a banking perspective, most bankers are looking for like 720 to 740, and landlords are kind of looking for anything above 700. So do you have a little work to do on your credit? If you're going for a loan, have you been pre-approved? And Steve's got a little bit of a different perspective because he does such a great volume. So he spends a lot of time pre-qualifying any potential buyer. I work with less people, but I know them usually personally. So, where's the money situation at with you? Because a lot of people get into a situation, they'll find a space, put an offer in, and then think that the seller is going to sit around and wait while they go and try to get funded and go for their loans or do their money raise. So you really need to be, a little bit further along. Deals can move very, very quickly. And so by the time you put your offer in, you're either going to need to have your pre-approval for your loan, or if you're going the investor route, memorandums of understanding or letters of intent that, they're pledging funds. Your investors will pledge funds once the lease has been signed. So for the seller, are you ready? You want to take this slide, Steve?
Okay. Which slide are we talking about? I can't see it very well. Let's see. Can I open it? Let's see. I'll get it a little larger here. We'd like to fool around with the screen. Okay, let's see here. Okay, there we go. I'm with you now.
Got it?
Yeah, I got it. Okay. All right. So we're talking about, the first bullet point, review lease language that pertains to sale. Okay. The big issue there is the sublease and assignment section of a lease if you're going to get a lease assigned. And the big the big gotchas to watch out for is that in a lot of these assignment clauses, we're seeing recapture provisions, which means that if you ask the landlord for, you're the seller and you're asking for consent to assign the lease, the landlord has the right to basically take back the premises and wipe you out. So you want to make sure that there's no recapture provision in a lease. If there is, you got to mediate that by basically not asking in writing for permission to have an assignment. So that's one thing. Another gotcha you got to watch out for is participation by the landlord in proceeds of sale. Some leases, landlords have the right to get up to 50% of the proceeds of the sale, which is going to be a deal breaker for most, buyers. They don't want to be working their butt off for all these years and then have to share half the proceeds with the landlord. So those are a couple of things, but maybe I'm getting too finite here. Maybe you should.
Yeah, I think that, what I see is that in most of my leases that I work with, as business owners in the state of California, you have a right to sell your business, and a landlord cannot unreasonably withhold approval for a buyer to come in, as long as that language that Steve is speaking about is not already embedded in your lease. But also, as long as you're bringing apples to apples to the table. So as long as you're bringing a buyer to the table that is as financially sound and experienced as you were when you took over, that transfer cannot unreasonably be withheld. If you bring apples and oranges to the table, then a landlord could say, no, you're not as financially sound, or, they're not as experienced as you were, so therefore, I'm not going to allow them to take over this lease. But the point is that a landlord cannot actually say, I don't like your concept, so therefore I'm not going to allow you to take over. Right. So, but in most cases, it's standard language or it's boilerplate language. And just remember that you do have a right to sell your business. There's just some little caveats you have to maneuver around with the lease. What else do you need to prepare when you're a seller, Steve, to get ready?
Okay. Well, the procedure that we undertake when we talk to potential sellers, number one, we like to see the premises. And understand the back of the house, the whole general, landscape of the business. We'd like to see if the business has been in business for at least 3 years, 3 years of tax returns, 3 years of year-end P&Ls, most current years, year-to-date P&Ls and sales tax returns. Obviously, this is a real hiccup year with the COVID. So, a lot of businesses we know have been closed since March 17th to currently. So, we'll talk about a little later about, the extraordinary COVID situation that you have to factor into the whole thing. But let's just talk about normal times. So we need those financials. We need obviously copies of the leases, any addendums to the lease, modifications to the lease. We need that. We like to, once we see the place, we go through the financials, we review the lease, we discern that there's enough time on the lease to make it palatable for the buyer to basically have the lease assigned to him, enough term, enough options, so we get a return of investment, return on investment. We do a broker opinion of value. And I think we're going to talk a little bit about, just very quickly, about the two basic methods for determining broker opinion of value. But the basic two methods are, an assets in place valuation.
You're jumping ahead. You're jumping ahead. Yeah.
Just correct me as you need to, because I'll go crazy. Yeah. All right. So let's just stay.
We're talking about, do you have them prepare an equipment list for you?
I do, but that's once I obtain the listing, I do that. So assuming that I do obtain the listing, yes, of course, we need an equipment list. We have an equipment template list, so they have an idea of, how it's specifically laid out. We also have them indicate on the equipment list what's not included, because frequently they have some personal artifacts in there, some artwork, a special pasta machine that's been handed down by, the seller's grandfather, and not included. So we put that. And if there's leased equipment or rented equipment, we indicate on that equipment list specifically what is not included. So it's very clear. So there's no, surprises. So
inventory too, right? Do you do inventory, Steve? Because I remember the first deal I ever did was Club 93 in San Francisco. And it was my very first deal, and we didn't address inventory. And when we took over the space after the license transferred, we walked in and there was a half a bottle of vodka left on the bar. And the owner was going to open the next day, assuming that all of the liquor inventory that he saw as he did the walkthrough 3 days prior was going to be there. So how specific are you around that, around a dollar value for inventory?
Well, on saleable inventory, what I do normally is I look at the tax returns, and in the cost of goods section of the tax return, it says opening inventory and closing inventory. And I look at a couple years of what they've put in there. And usually there's usually some similarity between those numbers. And then I just ask the seller up front, what's the approximate inventory that you have, your par inventory at cost? And so then before we actually close the escrow, they take a physical inventory, it's priced out and extended at the seller's cost, and the buyer pays it not to exceed a certain amount, which is indicated in the asset purchase agreement. So I don't get overly involved in saleable inventory up front. That comes into play when you're really doing the deal. So
yeah. Okay, great. So what is the importance of hiring a broker in these types of transactions?
Well, I think
and I know that your process is a little bit different than most.
But the same general principles apply. I mean, it's really basically to cover your rear end. California is a very litigious state, and if you don't make the proper disclosures, you're going to be liable for damages from a buyer. If you don't get the proper clearances in California, there's successorship tax liability for franchise tax board, the seller's franchise tax board tax, the employment development tax, payroll tax, and sales tax. So if you don't use an escrow and don't get clearances on those items, the buyer is going to be liable for potentially those successorship tax liability issues, plus any liens that may be against the property, any tax judgments, any liens from loans, a whole myriad of different liabilities that are hanging out there. So it's important, and this is how a broker comes in handy. He guides the whole process to assure that Mr. Seller, you're going to get out of this deal. It's going to be clean. You're not going to have any lawsuits, and you can sleep, well at night. And there are so many obstacles legally that need to be dealt with to make sure that there's not going to be any, ghosts that come out of the closet, once the deal is closed. So it's really to cover yourself legally is really
Right.
you want to use a broker.
And to procure a buyer, correct? I mean,
Well,
using the marketing
buyer to handle the whole transaction, overseeing the escrow, handling the lease transaction, dealing with the landlord, overseeing the due diligence on the buyer's part to make sure that the physical inspections are done properly, the review of the books and records are done properly, the transfer of all the licenses are done properly, and all the I's are dotted, the T's are crossed, and it's going to be smooth sailing, so there aren't going to be any surprises at the end.
And what's that fee, Steve?
Yeah, the fee typically
what's the seller fee?
For businesses, the standard business brokerage fee for businesses under $1 million is 10% of the sales price. And most brokers have minimums, and they will vary anywhere from 10,000 to 15,000 per transaction, depending upon the individual broker's desire. Yeah.
Great. Great. The other thing is, how important is it that the seller discuss their exit strategies with their attorney and their accountant? And specifically, I mean, obviously the attorney to review any documents or papers, but with the accountant in order to, avoid, paying like really large capital gains taxes and things like that. What's your recommendation there?
That's a very, very good point, Louise. Yeah, what I typically tell a seller before we list the business is have you talk to your accountant and figured out what the tax consequences of the sale are going to be. There are some situations where you're selling a business that's upside down financially. They may have a large tax loss carry forward and accumulative tax loss, so they can absorb parts of the gain, but there's certain parts, and only the accountant. And we tell clients right up front, we're not attorneys, we're not accountants. You need to talk. You need to have an accountant.
Don't play them on TV.
Yeah, you need to have an attorney. You need to have an accountant. And although we have standardized forms which have been vetted by the association of attorneys, it's still good to have the attorneys, review the forms. But the big point being is, you don't want the seller to be surprised that, he's selling this thing for $500,000, but after tax, he's going to end up with like $200,000, and he was expecting to end up with $1,000 because that's his retirement. Yeah. So you got to make it. Yes, I got to echo there for a minute. So as Louise said, it's important that you consult with your attorney and get the lay of the land in terms of what are the tax consequences going to be of the sale from your accountant.
Great. And in terms of talking to the landlord, what's your recommendation for bringing the landlord into the picture? And I'm talking generally, not during COVID, because we'll get to COVID later. That's a whole different can of worms. But generally speaking, at what point do you recommend that your sellers bring them into the conversation?
Yes. Well, when I'm doing my due diligence with the seller up initially to determine whether we're going to, enter into a listing agreement, obviously one of the key things in the transaction is the lease. So I usually feel out the seller and say, okay, I'd like to get some clarification from your landlord that, the transfer of the lease or a new lease is not going to be an issue. And there's going to be a reasonable base term with reasonable options, with reasonable rent, et cetera. And in some cases, the seller will say, no, you can't talk to my landlord. And I said, well, what's the issue? They said, well, first of all, I only have 2 years left on my base term. And, if the landlord knows I'm leaving, he may just, sweat me out, and maybe he wants to sell the place himself, or lease the place himself and get the key money for the business rather than you, Mr. Seller, getting the key money. There are some situations like that. Generally, those are in the minority. But the big issue is that, the seller may be of the frame of mind also that, he has a son that wants to get in the restaurant business. I don't know, if you only have 2 years on your lease, this may be a good opportunity for my son to get into this restaurant. I mean, things like this have happened. Generally not, but I'm giving you the sort of the unusual situations. And especially now in this environment,
Gotta move on, Steve. I've got to.
Okay. Maybe you should just preface that, I think you did up front, but maybe not. We're only covering things very peripherally. You want in-depth, information about any topics that we have. This course is really geared to like a day seminar. So we're trying to give you a broad brush. And so if you want additional information, you have my contact information. My email address is steve@restaurantrealty.com. Feel free to email me, and I'll be happy to spend time with you and go in depth into things we're just covering, superficially.
Yeah, and if you're SBDC clients, you can reach out to me too for more information. I saw a question come up that I didn't have a chance with Lauren, so we'll have to reach out to her. So I'm just going to move through very quickly and talk about types of acquisitions in purchasing a business opportunity. So there's a going concern, and then there is an asset sale. So I think if we can move through these kind of quickly, do you want to go ahead and take these over? Because this is kind of your expertise here.
That's fine, whatever you prefer, so fine with me. So an asset sale, basically what that means is that the business is not making money. It's maybe losing money or marginally profitable. Somebody that's going to buy this business has a better mousetrap. They're going to put a new concept in there, a new menu concept, a new name. They may do a cosmetic remodel, give it a whole new impact. So in that case, what's the basis for valuing that kind of restaurant? Well, the basis is basically it's a percent of the sales that it does. So if historically, based upon the 1,200 transactions, over 1,200 transactions we've completed, generally speaking, that most businesses that are doing sales volume between 90,000, or you can even say 50,000 to 500,000 in sales, they are selling approximately at 30% of sales. So if you're doing 150,000 in sales
a year annually,
and you're not making any money, the sales price would be 30% of that. That's just a rough and dirty. There could be adjustments to that based upon, if you have a liquor license that's underutilized, and it's worth 150,000 and you're only doing 5% liquor sales, so you do an adjustment for that. If you have a long-term below market lease, you may do a discounted cash flow analysis of the lease. But again, if you want more detail on that, email me. So we're just doing a broad brush here. So generally speaking, restaurants doing between 90 to 50,000, selling for 30% of sales. Restaurants doing between 50,000 to $1 million of sales are selling for about 25% of sales. So if you're doing $1 million a year, 250,000. Quick and dirty. If you're doing over $1 million in sales, generally selling for 17% of sales. So the higher the sales, the smaller the percentage. And this is based just not from pulling things out of the air. This is based upon over 1,000 comps that we have of deals we've done and a compilation of that data. So that's how we come about with this information. Okay, so that's the assets evaluation. The second is the going concern, and it's basically a multiple of seller's discretionary earnings. Okay, what's seller's discretionary earnings? You look at the net income on your tax return and you add back all the personal economic perks that you got out of the business. It could be a salary, it could be auto allowance, it could be insurances, life insurance, health insurance for yourself. It could be auto entertainment expense. Then you also add back to the net income on the tax return. You add back depreciation, which is a paper expense. You add back interest expense, because most of these deals we're doing are all cash. Okay, which may be a little different from what my associate here will be talking about. But anyway, most of our deals are all cash, so there's no interest expense. And again, if there's net operating loss carry forwards, you would add that back. You'd add back non-reoccurring expenses. What's a non-reoccurring expense? Suppose you had an audit, you had extraordinary legal costs, or you had a lawsuit and you had extraordinary legal, you would add those costs back. And then you would add back lease adjustments, because if the buyer's rent's going to go up dramatically, you would do a negative adjustment on the seller's discretionary cash flow. What you're trying to do is show a picture to the buyer what his realistic cash position is going to be owning this restaurant with these kind of adjustments. Additionally, what frequently happens is that sellers will buy a big piece of equipment, let's say like a major refrigerator, which should be depreciated, it should be on the balance sheet, and instead they write the whole, let's say it's $3,000 item, they write the whole $3,000 item off on the income and expense statement, the P&L. That would need to be adjusted as well. So there's some other things, but that's generally, so you take that number, which is called seller's discretionary earnings after all those adjustments, and then you use a multiplier. And the multiplier traditionally for non-franchise, non-chain restaurants, independent restaurants, is about 2.2 times the SD. And what we do is we look at 3 years of SDE and we take an average weighted balance. We put the most weight on the current year, the next most weight on the second year, and the least weight we put 40% on the first year, 2% on the second year, and 25% on the third year. I may be in those numbers a little wrong, but they should add up to under. We take a weighted balance average, and again, like this COVID or the Great Recession or the dot-com bust, we do adjustments, because those are extraordinary years, and you've got to look at things differently because of that. Okay, that's a very overview, very rough. Okay.
Great. Well, so let's take a look at what we're seeing now during COVID. I mean, I'm seeing a lot of closed businesses, people trying to sell their businesses, they're closed. It's just asset sales and taking over the lease. I'm seeing a lot of direct deals with the landlord, both with and without key money. And key money is a dollar amount that you would pay to a landlord if there's assets there, like a fully equipped restaurant or a good portion of the equipment, there's a value to that, right? So if the seller is no longer in the picture, you would be dealing directly with the landlord, and the landlord would understand the benefit of those assets. There may be a little key money. We're looking at best offers or just people taking over leases. I don't know what you're seeing right now, Steve, but I'm seeing a lot of deals that are, their business opportunities, whether they're asset sales or going concerns, but I'm spending a lot of my time negotiating with landlords for adjustments on the lease because rents are about 30% to 50% of what they were previously. And then there's a lot of scenarios where there's, free rent built into that just because there's a big question mark on, what the future holds. And we're also seeing, I'm working on more subleases than I've ever worked on. And that's where the seller allows an operator to come in and they sublease, their business to them. Just to get off the, cut the bleeding vein. I don't usually delve in that realm, but I'm starting to see more of that. What are you seeing?
I'm seeing a lot of what you described, but I'll give you a specific example I'm working on right now. It's a closed restaurant, and however, the owner of the restaurant also owns the real estate. So we're trying to sell the real estate and the business to one person to buy both. But in case it turns out to be two different people, which is one deal we're working on a couple of different deals, but on this one deal that I'm describing to you, there's a separate buyer. In this case, it's a lessee. They're not paying anything for the FF&E in the restaurant. They're just buying the ABC license, and the cost they're paying for the ABC license is about 50% of what it was pre-COVID, because most licenses, hard liquor licenses, have gone down by about 50%. Since the COVID, because of the number, it's supply and demand, which drives the pricing. So in this case, they're going to buy the license. There's a little inventory in there, wine inventory. They'll pay the inventory costs. But here's what they've got on the table with the landlord. They in this particular area, they only allow, as is the case in most of the state, outside dining and delivery and takeout. So their attitude is, first of all, they're going to be doing some remodeling. So they want free rent for the first 6 months, unless they're able to complete the remodeling before that 6-month period is over, in which case they'll pay half rent. And in any case, they will continue to pay half rent until they allow indoor dining. And once they allow indoor dining with the outdoor dining, then they will pay full rent. And then if worst case scenario occurs and there's another surge and the governor says, okay, no outside dining or inside dining, they will pay no rent. And that's a difficult pill to sell to a landlord, especially if they have a mortgage to pay. So that's not going to work with every landlord. But in this case, we're structuring a deal, we're selling the building, we're doing a lease at the same time. So we're negotiating with the buyer of the building that this is the way it's got to be. And so, but irrespective of that, those are some general parameters, a combination of free rent, stepped up rent. As Louise mentioned, rents have dropped. So it's a tough road, but in a lot of cases, especially these big time landlords, you know, they'll just take the position, you know, we're not giving you any relief. I mean, I'm a landlord and I had to give my tenant a 30% discount for 4 months. And fortunately, his model is takeout and delivery. So his business was 60, 70% takeout and delivery before the tenant.
I think we need to move on, because otherwise we're going to be way out of time.
Okay. Got my email. Yes.
Okay, so thank you. I'm going to move on to allocation now. So when you go through escrow, you'll get escrow paperwork that has allocation on it. And what you're basically doing is, in the state of California, you're listing your sales price and you're breaking it up into these categories. So you add all of these up, it should equal the sales price. It's a requirement. And so this is another way to take a look at evaluation. You know, it's furniture, fixtures, and equipment that has a monetary value, inventory, the liquor license, wine and beer, which Steve talked about, the lease value. So the value of the lease, like a 3-month lease versus a 20-year lease. There's definitely a monetary value there. Your leasehold improvements, that's in other words, the build out that you never had to do. You know, of the 1,000 square foot space at $650 a square foot, you know, that improvement has a value. And then a covenant not to compete and goodwill. And so you'll, again, be required to list this out through escrow. So I want to talk a little bit about the process. Buying a business opportunity, whether it's an asset sale or a ongoing concern, is a 2-step process. The first step is the contract between the buyer and the seller, establishing the price and the terms. And the second step is the negotiation with the landlord, if that landlord is different from the seller, for that buyer to first get approved, and second of all, to either acquire a lease or a lease assignment. Okay, I'm not going to do a deep dive into this, although I could. I'm going to move on. The process also usually involves the transfer of a liquor license. And if you're transferring a liquor license, you have to have an escrow. It's a requirement. And all monetary consideration has to go through escrow with the transfer of that license. So that's something really important. Escrow is really important, both for a seller, as Steve mentioned earlier, you know, to protect you from any issues that could happen down the road. But it's also really important for the buyer to make sure that they are acquiring a business that is free of any liens or encumbrances, because one of the things that escrow does is they reach out and they make sure they contact all of the taxing agencies and make sure that basically all of the debt has been cleared before they allow that escrow to close. Process and art of the deal. Want to spend just a little bit of time here. What to expect when you're a buyer. In order to get that upfront information about the business, you're going to have to sign a non-disclosure agreement, which basically says you're not going to go and publish all of the information in the San Francisco Chronicle of this financials of said restaurant, right? So got to keep it under wraps. It is, you know, it is information that you have to keep confidential. And what, you know, generally speaking, this is where Steve and I differ a little bit. What I ask for prior to submitting an offer, in order to be able to get it, you know, you don't have to do a deep dive in the very beginning. You know, you have to basically get enough information to put in a good faith offer, because what happens after your offer is accepted is that you'll get a period of time in which you can do a buyer investigation, and that buyer investigation ends up being a contingency, so you can back out if it's not acceptable to you. So the basic things you're going to ask for up front are a copy of the lease, P&Ls and tax returns, and an equipment list. And with those 3 things, you should be able to make a good faith offer. And again, I know Steve's a little bit different on that one. He does a deep dive up front. I don't, because I know my clients, and he does a higher volume. You're going to want to do the contract in writing. You know, I don't believe in verbal contracts. I don't think Steve does either. That way you get out of, you know, 10,000. I thought you said 1,000. You know, you actually have to have it in writing. It has to be in writing, and then strongly recommend getting representation. I've done a lot of deals where people are using their attorneys, and that's okay as long as your attorney does a lot of restaurant transactions and knows the ropes. Because I can't tell you how many times I've done a deal against an attorney, and I've spent all of my time bringing the attorney up to speed on how things are done in the brokerage world. And I basically should have just been the dual agent, right? And I did see a question on this, so I'm just going to go ahead and answer it right now. Is dual agency okay? And dual agency is when one broker represents both sides. It all depends on the broker. You know, as long as the brokers are ethical and fair, and they have a great reputation. Steve does it all the time, almost exclusively. I represent a lot of buyer-seller scenarios. The advantage is that the deal can go a lot quicker and more seamlessly. The downside is that if you're not using ethical brokers, then you might not get full disclosure. What you have to remember in those situations is that you know, the broker actually owns a fiduciary responsibility to the seller, and what they owe to the buyer is full disclosure. So again, it's not always, you know, there are pros and cons to it, but you just have to have faith in the broker that you're using. And finally, being honorable. You know, it's really important, you know, to there's nothing worse than a buyer who doesn't understand the etiquette of business brokerage. And that's one function that your broker can help you with, because you don't want to go around unknowingly insulting people and then losing your deal and not understanding why. You know, if you lowball a seller because you think every sale is a fire sale, and actually they aren't in, you know, non-COVID times, then, and you come in with the attitude that you're going to do the seller a favor by taking it off of their hands, you're going to lose your deal, you know. Or you might think that you're going to jump over this seller and go directly to the landlord to strike a deal where I don't have to pay anything for this business opportunity. And the problem with that is that an ethical landlord, and that's most of them, is going to send you straight back to the seller to negotiate a fair price. So in this process of doing that, you will have disqualified yourself with the landlord as well as with the seller. So the best deal are reasonable, where the seller can exit with some dignity and everybody can walk away with something. And that's kind of the art of the deal from my perspective. Steve, do you have comments on any of this you want to address?
Yeah, on the dual agency, I think that, you know, on our NDA, we specifically say that, you know, we could potentially be a dual agent. And in business brokerage, generally, 80% of the transactions are dual agents. The reason for that is because residential brokers, general commercial brokers do not understand restaurants. And restaurants are, you know, a specialty all to themselves, dealing with entitlements, dealing with liquor licenses, etc. And so what we do typically is, you know, we tell a buyer right up front, you know, we will most likely be a dual agent. You know, you don't have to have us be your dual agent, but it's really in your best interest to do that because we understand all the nuances, and the biggest time killers in a deal is surprises and time. And those surprises and time problems will occur if you deal with an agent that doesn't understand the process of selling restaurants and all the nuances involved. So, and we also tell in the NDA right up front, we tell the seller up front, when we get the listing, we don't want to know, Mr. Seller, what your bottom price is. And Mr. Buyer, when you sign the NDA and when you get involved in making an offer, we don't know what, we do want to know what your bottom line price is going to be. We want to bring both buyer and seller to the table and create a win-win situation and have a free-flowing negotiating process going back and forth until both parties are satisfied that it's the price that makes sense to both sides. And that's how the process works, and it usually works without an issue. So that's how the dual agency works. As far as our process on the NDA is, once when we're selling a confidential sale, we want to know something about the buyer's operating background and financial background before we're going to give the name and address or any information about the business to a prospective buyer. We want to make sure they're qualified financially and operationally, because if they can't get to first base with the landlord, they're not going to be able to certainly get involved in a transaction. So that's a real important fact. So I think that
right. Great points. So continuing with process, a lot of times there is something called seller carryback. And that is when a buyer might be walking around with $100,000, but the deal is $150,000 and they just can't come up with the last $50,000 because they need some, money to open the business and get it off the ground. They need their working capital. And so sometimes they'll ask the seller to carry back that $50,000 or whatever the amount is. It's usually always more than 50%. Otherwise they will disqualify themselves. But in that way, they can get their deal, and there may be some benefits for the seller in that, especially they may be able to avoid taking a capital gains hit all in 1 year if they're doing a small note that is over 3 years, maybe up to 5 years. They can take those write-offs over an extended period of time, and that may be a benefit to them. These are UCC-1 filings with Secretary of State, and they lien the business. They lien the assets of the business. So that's generally how they're guaranteed. When I do seller carryback, I always also ask the buyer to personally guarantee that note, just in case there's default there. Steve doesn't usually do a lot of seller carryback. Most of his deals are all cash. So again, if you've got questions on that, you can contact me. Also, from the buyer's perspective, if I'm representing the buyer, and generally speaking, when you're doing a business opportunity and there's a lease that you're inheriting, which generally speaking, you want to take the advantage in most times, not in COVID times, of taking a lease assignment because that's usually going to be the cheaper rent. Right now I'm seeing something totally different than that. But if you are taking an assignment, there's not really a lot of negotiation around that. You're going to accept or inherit an already existing lease. There may be a fabulous 15-year lease with super cheap rent. Why would you go in and ask the landlord for a brand new lease? You're going to want the advantage of inheriting that fabulous lease, right? So there's not a lot of room. You're just going to accept it, and the seller is going to hand the rights over to you. You're going to accept it. The most that you might be able to ask for are some fringe things, like maybe a 5-year option, or a couple of months of free rent if you're going to be doing an extended, or an expensive kind of build out. But if that's not the case, there's usually not a lot of free rent that goes with an assignment if you're not doing a lot of construction work there. So then there's early possession, and that is when a buyer takes possession of the space prior to the close of escrow. Okay, there are some benefits and pitfalls for that. It's beneficial for the buyer because they can get in and they really understand the space and know if there's anything inherently wrong with it prior to the close of escrow, so that they can put a demand into escrow and ask for some money back. It may benefit the seller if they're bleeding money and they need to, cut off their expenses prior to the close of escrow. They can have the buyer take over early possession, and now all they're doing is waiting around for their escrow to close and for them to receive their check. So those are the benefits, but it is fraught with liability. I can't delve into it right now. Bottom line on that is you have to know and trust your buyer and seller in order to allow any kind of early possession. Yeah, go ahead.
Real quickly on the early possession thing. We did one deal in Southern California, early possession, and one of the prerequisites of early possession, all the buyer's money's got to be in escrow. He's got to have liability insurance naming the landlord and the seller, insured, etc. And basically what happened was the seller made all these disclosures on his disclosure statement. My taxes are up to date. You know, I don't owe any vendor debt or anything. So anyway, 2 days after the buyer has possession of the premises, he's running it as is, he's buying a going concern, he gets a call from the IRS. And the IRS says, is Mr. So-and-so there? They're asking for the seller. And no, he's not. He says, well, we're closing you down tomorrow because, you know, you've been notified of all these IRS tax liens, and we're coming in and closing you down tomorrow. This is a true story. And consequently, once the buyer heard that, he lost total confidence in the seller and just assumed the seller misrepresented everything else on the disclosure statement, everything else about the business. And he said, I'm not doing this deal. And basically unwound the deal. So that's just an example of one of the negatives of early possession. That's an extreme situation. Sometimes. Yeah,
and it's fraught with liability. And what I also do on you know, kind of layering in another, you know, paperwork that I do is I have an early possession document, which states that if the buyer, you know, if the escrow doesn't close due to the fault of the buyer, you know, then the seller has the right to take back, you know, an escrow does not close, the seller has the right to take back the business, you know, and it voids the lease. And so again, this is where you want to have a seasoned broker that has done tons of deals, or you want to be using a really, really good attorney to help you through some of these liabilities. But I don't, you know, I know I've got to move on here. So, so understanding the contingencies. So basically in the state of California, there are 3 contingencies for every deal when you're buying restaurant, bar, or nightclub. And a contingency means you have something has to happen or you get to back out, right? So the first contingency is your buyer investigation. You know, you get an allotted amount of time where you get to inspect the business. If something doesn't, you know, end up being as it was disclosed to you or as it appeared to be, then you get to back out if you want to, you get to move forward if you want to, or you get to go back to the table and renegotiate. So that's contingency number 1. Second contingency is a lease with terms acceptable to buyer, right? So if you don't get that lease, or the landlord doesn't accept you, or you don't get the terms that you'd asked for in your contract at the very beginning, then you get to back out. And the third one is the successful transfer of the liquor license. So there are always 3 contingencies, 3 points in that deal where you as a buyer would get to back out. So sellers need to be aware of that too. Go ahead, Steve.
I could just add there are a couple other contingencies, could be a couple other contingencies, which is a franchise. You need to get approval by the franchisor, or if it's financing and you're dealing with a third-party financing institution like SBA or a bank, it could be subject to financing contingency.
Right. The financing, you know, actually has to be in the contract. You know, you have to tell them that, you know, I am going for, you know, a loan. You have to disclose what you're going for, because the seller needs to have that information up front to decide whether they're going to continue with you or not. You know, sometimes putting a deal on the table where the financing is a contingency when the seller has a short time frame is not always, you know, you're not always going to get your deal to go through that way. So, you know, it's just, again, you have to discuss that with your broker. Preparing for the license transfer, you know, that usually happens after you get your lease. You know, you will, it's a pretty complicated application and you have to fill it out absolutely perfectly. One thing that we always run into is that all of a sudden a buyer comes over and wants to put the big notice up in the front, and seller hasn't told their employees yet. And if the deal is that the restaurant has to stay open through the close of escrow, you can see a lot of your staff jumping ship at that point in time. So you really want to prepare your staff. And a lot of ways we do that, especially over the last couple of years when we've had a lot of, workforce has been a real struggle. A lot of the staff wants to stay, and a lot of the buyers want to take on the staff, or at least have the ability to interview them. So what we've been kind of helping to make it a seamless transition by notifying the staff on the day that the posting goes up, that there is a buyer, that they're coming in to interview staff, and that they should bring their resumes. And so, sometimes I've had sellers who have offered bonuses for people to stay on through the close. So it's just something that needs to get finessed a little bit.
Louise, on the topic of the license transfer, there was a question that came in, which I think needs to be cleared up. It says, they're curious to know if you could begin a liquor license application prior to finding the right opportunity to save some time, like you can get pre-approved for a mortgage.
No, because when you're doing your application, you actually have to already have your lease. So, first you do your contract, then you get your lease, approval and your lease, and then you go for your license transfer. And these are the types of licenses that you're going to go for, for business opportunities. It usually includes the license. So that's a person-to-person transfer, right? So in other words, the license is staying in the same place and it's transferring from person to person. It's very, very different than if you're starting a brand new restaurant and doing a build out and you're going to ABC for a brand new license. In that case, it's if there's one available at all, that'll go to the premise. If you're buying it on the open market because maybe there's a moratorium and no new licenses, that would mean you'd have to go and look for it on the open market. And in that case, that would be a premise to premise. So you're bringing it from this restaurant and you're moving it over to yours. But for the types of transactions that Steve and I usually do, which are the business opportunities, that license is usually included with the transfer. And so that's a person to person. So it wouldn't really make a lot of sense, to kind of go for it up front. Okay, I know I'm running like super behind, so I'm just going to click away here. So again, any questions, you can go to Steve. You can come to me. These are the 3 main sites that you can go to. That's where sellers usually list their businesses, and buyers usually are, perusing in order to find what's on the market. And there are deals happening right now. Buyers are really looking at the opportunity to get in where maybe they couldn't have done previously, or getting a deal. And a lot of sellers just, are looking to exit at this time. So I don't know how you're feeling, Steve, but I'm kind of seeing it bubble up. So can I hire Louise to be my broker? Sorry, folks, I cannot represent any SBDC client or client that has attended an SBDC training. That would be a conflict of interest. So I can't represent you. Okay, just wanted to clarify that. And this is what we reviewed. I'm not going to do a knowledge check. Are there a couple of questions I can take, Alan, right now?
Yeah, there's one that came in quite early, which I think is a great question, which is why buy at all when you could just lease a vacant space?
Because if you lease a vacant space, you'll have to spend $650 a square foot. So for 1,000 square foot space, that'll be $650,000, when you could probably get a really great restaurant for, in normal times, fully equipped for maybe $350,000 or less.
And the license transfer as well, I would guess.
And the license transfer, and most of the permits already intact. We recommend that for a first-time restaurateur, because you'll spend all of your time otherwise, going through the permit project, managing contractors. It'll be a year to a year and a half to get yourself open. I did that. I was exhausted by the time I opened, you know, my first location. And so it's just easier, and you can stick to budget, right? You can really stick to your budget.
And there's one other one I think is worth, I want to pick up on here, which is somebody said that their business is less than 3 years old. And I think Steve talked about producing 3 years of financials. So does this mean we would have to do an asset sale only if we're going to try and sell, or would they be able to, because would they be hard pressed to find?
No, we would work with whatever they had. If they had just 3 years, that's fine, or 2 years, or even 1 year, that's fine. Yeah, we can work less than 3 years.
One thing to think about, Jyoti, with that one is that, you know, SBA, in order to loan to a buyer, is going to want to see 2 to 3 years of profitability. So that's why, as brokers, we kind of, why we look for that sort of kind of becomes the benchmark, you know, so that there may be some financing available. So, okay.
I think that's probably, yeah, but then there's some more, which if we do get time, we can cover afterwards.
Okay, so I'm going to jump straight over to section 2, which is acquiring a lease or assignment. I want to really blast through this because we've done about 3 webinars on lease assignments and leases already. So again, the second type of acquisition, if you're not purchasing a business opportunity, it would be doing a direct deal with a landlord. So you're not buying anything here. It's just you're taking over a lease. And it's a one-step process between a tenant and a landlord. There may be some key money involved if you are, you know, if there are some assets there, okay? So you're acquiring a space that is for rent or lease. You'll be negotiating a brand new lease with a landlord. And this is, again, it's a new lease. So you get to negotiate till your heart's content and get the exact lease that you want. You're not inheriting anything. If there is FF&E and infrastructure, you'll usually pay the landlord some key money. And if there's no infrastructure, you will perform a build out on a vanilla space. The approval or qualification process with a landlord is usually an application. It's a credit score, business plan and financials, and a personal financial statement. So how do you show up in the world? What have you got? A lot of those landlords are looking for property or assets in order to approve you. But it's sort of a mixed bag depending on who the landlord is. Any comments on this, Steve? I'm trying to go through it as quickly as I can.
No, just a big thing on assignments. You know, the problem with an assignment is that the assignor, who's the seller, has to continue to guarantee that lease for the base term and any subsequent options in the state of California, which is a biggie. So if you got 3 years left on your base term and 2 5-year options, you as the seller stay on unless you can negotiate a burn off with the landlord that, you know, after the first term, you're off the lease of the bond.
Oh, Steve froze up.
You're concerned? Okay. Then move on, and if
okay, I'm going to see if I'm just going to go on here.
Entity.
Okay, you froze up there, Steve. Sorry. So again, you can get a brand new lease, a lease assignment, which is usual with a business opportunity. You can also negotiate options. An option is an extended period of time. It usually belongs to the buyer, and the buyer has the right to either exercise it or not exercise it. The benefit is that you're not going to get caught into a great big long lease if you don't want to. There's some wiggle room. The downside is that usually, unless there's specific option language in there, which says it only graduates, you know, 3% every year or something like that, an option will usually go to market rent. And in the Bay Area, market rent, you know, is usually increases about 16% every year. So you know, it's a question mark there. So that's the downside. You can do an extension, which is kind of embedded. It's an extension of the existing lease. And also you will be paying a security deposit. And if the landlord doesn't think that you're, financially sound, they may ask you to put a very large security deposit down, and then maybe that burns off over time as you start to, show that you're a good tenant. What should you ask for when you're negotiating with the landlord? I tell my clients everything. Ask for everything. Ask for free rent if you're performing a build out or an extensive remodel. Everything ADA, everything ABE if you're in San Francisco. Make sure that you get full disclosure, and that if there's a retrofit coming around the corner, you want to know about it. Ask the landlord to take care of the roof, the earthquake retrofit, and anything structural. There might be some other tenant improvements that you can get the landlord to kick in for if they're motivated. Make sure the lease is transferable, and this goes back to that language that Steve was talking about earlier. And again, always have an attorney review the lease. How am I doing on time here?
Yeah. Well, it's 3:07 now, and
okay.
it's supposed to be 3 o'clock.
So what should I choose? Buying a business opportunity or acquiring a lease and performing a build out? Those are kind of your choices. Okay. So this is what we reviewed. I'm not going to do the knowledge check. I'll take a couple of questions now, Alan.
Okay. So, so there's one I like, which was coming back to. I think we've covered a lot of this. It's the differences between buying a business that's still operating and one that's currently closed. There was another question about should you wait until after the dining is allowed by the county before you even bother listing.
That's a good question, Steve. Do you want to take that one?
Yeah. Okay. If you have the wherewithal to, stay in good standing with your landlord and keep everything current, and have the energy to restaff your restaurant, et cetera, and get it back to the normal level of sales and earnings that it was pre-COVID, I think you're better off to do that. But unfortunately, most people don't have that wherewithal, either emotionally or physically, especially if they're baby boomers. They just don't want to go through the ramp up, and there's no assurance that they're going to get their sales and earnings back to the level they were pre-COVID. Maybe years, and they just don't, again, physically or emotionally have that stamina to pursue that. So it's an individual situation. If you had a restaurant that worked well through COVID, their model is primarily takeout and delivery, and I've got a few of those listings, especially pizza takeout restaurants. They've actually gone up in value. I mean, they've gone up in sales, and so their values have maintained, and you can still get SBA loans on them. But if a restaurant is closed or as ran at a small percent of their sales during the COVID, are not going to be able to get an SBA loan until 24 months after basically it's sold or it's been up and running. So there's a problem if you need to finance a restaurant, that you're purchasing.
Okay, and there's kind of one other question which I like the look of. Where this comes back to the broker question: who pays for the broker? How does a buyer motivate a seller to use a broker if they don't want to spend the money on it?
Buyer pays the fee. Usually the seller pays the fee, and then if there are two brokers involved, the brokers share the fee. Right. That's the rest of the world. And then there's Steve. How do you do your fee schedule?
That's how you've done. I mean, we're a dual agent in most cases. The seller pays the fee. And again, if we do have a cooperating broker, we split the fee. And that's how it's traditionally done.
Yeah. So that it's nothing that really, if there is a,
believe me, if you're talking to the sellers, you're going to get more than your cost of your brokerage fee back by working with the seller, because you're going to get the maximum value, especially if you work with a company like us that has exposure to 60,000 buyers and are in their faces every week. So if you're trying to sell it yourself, you're going to have a limited world to go after as far as marketing your business. We're going to have a much broader world working with a broker that specializes in selling restaurants to get a higher price that's going to take care of the broker and get you more money than you would get ordinarily if you were going to try to sell the business yourself.
And how many times have I taken phone calls, or my assistant has given me a phone call and said, no, they don't want to pay the fee. And I'm like, oh, they'll be back. They'll go through 2 botched deals and then they'll call me, and they always call. It's like I always hear from them down the road.
Covering your rear end is so important, as the thing I mentioned earlier. You got a lot of legal liability out there. And if you don't dot the T's and I's and cross the T's properly, you have a good chance of having some legal issues down the road. With a broker, that will be minimized or eliminated if it's a broker that knows what they're doing.
So there were a couple of questions around money, and one of them I'd like to get an answer to is, what's the best way to find investors if you're having a hard time with banks or lenders?
Well, there's always a seller financing portion of that, depending on, if the seller is willing to, finance that as a note. You can reach out to us. We have an amazing advisor by the name of Paul Bozzo, who is an investor specialist, and we can give you some sessions with him if you're an SBDC client. It's not something I really kind of have the time to cover today, but it's a great question, and I want to get it answered for you. So reach out to me. I think what I'd like to do is, and I flip these slides around, I want to talk a little bit about exit strategies, because anybody that knows me or any of my clients know that we always strategize an exit before I ever allow them to sign a lease, because I think it's just as important to know how you're going to get out of this business as it is to get in. And we have a saying in real estate that it's either time or money. So in instances where you have to exit, if you have time, you can wait it out. You can probably get a little bit more money. If you have to exit quickly, you have to be more aggressive with your pricing and with your sale, and you won't get recouped as quickly. But how do you know when you should sell? Obviously there are factors like with COVID where, as Steve mentioned before, we just don't have the heart or the energy for a relaunch, right? It's time for the younger generation to come in and let me hand off the baton. Now we're kind of hearing that. But also, like, what about those restaurants that have been doing, just okay? They've been hovering around break even for about 5 years, and the seller's like, okay, I haven't paid myself in I don't know how long. When do you get out? You need to be able to give yourself at least a good 6 to 9 months to be able to successfully sell a restaurant. So in thinking about that, you really, really want to make sure that you have enough working capital to be able to manage that time frame. And then all of a sudden, as Steve mentioned earlier, all of a sudden you've got, Board of Equalization saying, I'm taking your license, you haven't paid your taxes. You don't want to get in that kind of a situation. So really thinking about in your mind, okay, if I ever go to exit, I want to make sure that I give myself at least 6 months to do that. I hire a broker, it's marketed properly, and I'm setting myself up for success, and using, using a broker which knows the systems, and then they're going to make sure that everything is done, timely. And I tell my clients, the success rate is about 30% for restaurants. About 70% of restaurants are going to be back on the market again in about 3 years, either due to a lack of capital or a lack of management skills. And so, the good restaurateurs, and we all know them, they've had multiple locations and they haven't always made it. And a good restaurateur will know, I've got clients in San Francisco where they're serial restaurateurs and they're like, oh, this location isn't making it. And they jump ship as soon as they figure it out. They're not going to hang on and take out equity in their home and take perfectly good money and throw it to bad. They know they've got to exit and start their next project in a new location. Restaurateurs, more than any other industry, we're stubborn, and we're just going to want to hang on and suck the life out of a deal which we should have let go of a year ago. And I always like to share that information. And this is one of the reasons why I always do an exit strategy with my clients before I allow them to sign a lease. So we've had this conversation, right? Understanding that your industry cycle is about 7 years, right? So do you want to take on a 7-year lease? No, because at the end of 7 years, all you're doing is closing your doors and walking away. There's nothing to sell. If you have no lease, you have nothing to sell. It's your biggest asset. And so you want to have at least maybe 10 years on that lease, so that when you get to year 7 and you decide maybe you want to sell, you can turn around and sell it to somebody and at least give a buyer 3 years, and maybe they can go for an option, right? Because that's going to give you the highest price for your business, rather than trying to sell it with no lease. If you're trying to sell it with no lease, it looks like a fire sale, and you're going to pull the most unqualified people out of the woodwork. I call them like wolves. They're going to be like circling and salivating and sniffing, and you're going to just attract the wrong kind of buyer. The best exit strategy, and tell me if you agree with this, Steve, is to purchase the real estate. Because when you purchase the real estate, if you have the ability to do that, and most people, depending on where you are, you have if you actually purchase the building, your mortgage payment will probably be lower than the rent that you're paying right now, and so you could go in, you could run your industry cycle for 7 years. And at the end of it, maybe you decide you want to sell your business. Maybe you sell it for $500,000. You get a new tenant coming in. You sit back. You let them pay the mortgage down. And at the very end, when you go to retire, you've got an income property. That is the best exit strategy if it's possible. So, and it's times like these when we're in COVID, when the prices of buildings are dropping, and this is if you have the means, I want to encourage you to think bigger rather than smaller, and think about those exit strategies. You have anything to add to that, Steve?
Well, yeah, I agree that it's very hard to buy buildings in the Bay Area, because most buyers, restaurant owners, can't afford the buildings, and the owners of the restaurant or the buildings don't want to sell them. So over the years,
have you seen what's available right now? I saw the map and it was just covered.
Covered with buildings for sale?
Yes.
In San Francisco, with restaurants?
In San Francisco.
And what's the average price of one of those buildings?
I didn't delve into it. I was sent the information by Stu Gary, but
yeah, they're multi-million-dollar deals. A guy that's buying a $200,000 restaurant usually isn't equipped.
But we have to remember here that a lot of the people are coming from Northern California and not just San Francisco. So.
Yeah, that's true. No, most of our building listings, we probably have 30 or 40 of them, and I'd say they're in secondary, tertiary areas. They aren't in the Bay Area because the price of real estate is so expensive. Occasionally, we do sell buildings in the Bay Area, but when they do become available, they're mainly in secondary areas, tertiary areas. But it's great if you can buy your own building, sure. And SBA loves to do 7A loans on buildings.
Rates right now are really low, as our finance team in all their Monday and Wednesday sessions are always talking about.
Yeah, now's a great time to buy a building with a business. Yes.
Yeah. So the options right now, I mean, if you're looking to exit, it's selling your business, and again, take a look at that lease, make sure it's fully transferable, know what you're getting into. We are doing deals right now. I'm doing deals. Are you doing deals, Steve?
Today we closed our 17th deal in COVID, and we've done over 40 deals this year. It's not like last year. I mean, last year we probably did 60 deals, but it's still, we're busy. They're smaller deals, generally speaking. It's a buyer's market, needless to say. Sellers are getting killed by and large, and they're definitely compromising. Unless it's unique, like, a takeout pizza place where they're getting as much or more than they would pre-COVID. So every deal's got their own little nuance to it.
Right. Yeah. There's usually a lot of negotiation going on with the landlords for the leases too, is what I'm seeing in my deals. But so that's your option, and again, if you're struck by COVID and you don't feel you have the time span, that's 6 months at least to be able to sell, then, really you've got to start negotiating an exit with your landlord. We've done a couple of webinars. Steve and I did a webinar a couple of weeks ago on this. So we can help you to, come up with some strategies, give you the recordings to those if you need help in this area. And then your final would be kind of default and or bankruptcy, just to wipe the slate clean. Is there a workshop coming up, Alan, on bankruptcy?
We know that we don't have one scheduled. We're trying to get one. We had someone lined up, but they
Most bankruptcy attorneys are too busy to have time to do a webinar.
That could well be the case. Yeah,
they were like going out of business, bankruptcy attorneys, for the last few years, and now COVID, they're back in the game. Big demand for them.
Right. So I'm probably just going to do the wrap up now. Let's try and answer some questions. I've missed a section here, and I apologize for that. If anybody is interested, please contact me. I have a complete webinar on how to purchase a restaurant and negotiate a lease, and I can send you the recording so that you do have that information rather than me just glossing over it. Just because I want to make sure that some of your questions are answered. Alan, do we have some questions?
we have several. Okay, so this kind of comes back to what we said a second ago, is how hard is it to get an SBA loan for a restaurant with property?
Well, if you want to go first, Louise?
No, go ahead, Steve.
Fine. Well, if the restaurant has had greatly reduced sales or no sales during COVID, forget getting a loan on the business portion of it until basically you're up and running for about 24 months. That's the general consensus of SBA. If it's a 504 loan, which is on the building, not a problem. They'll do 80 to 90%, 85% for sure. But they want to make sure that you have enough money to cover the cost of the mortgage plus the insurance on the building and the taxes on the building until such time as the business gets up and running. Like, for example, we're selling a bar right now with a building. And again, the lender wants to make sure that because the bar's not going to be able to be in full swing for many months because of COVID, that they have enough money, discretionary money from their other sources of income to pay the mortgage and the taxes and the insurance on the building mortgage that they're buying. So and again, SBA is backed up because of PPP loans. And so it's still there, but it's slower than normal. And interest rates are low, which is positive, 4.5%, 5% money on SBA.
Monique had a question about what should they expect if they're preparing to buy a property for an existing business?
On the building side?
Yeah,
go ahead, Steve. You want to take that?
You're talking about that's been running as normal during COVID? Is that the question? Or
I would guess so.
Well, if that's
I would expect this to be some sort of expansion piece. So they.
It looks to me like they're buying a property that has an existing business in it. What should they expect?
Well, they can get 80% on the business and 80% on the building, SBA. Assuming the business will, has been viable through COVID. If not, then they're not going to be loaning on the business portion. But on the building, they will, again, assuming there's enough income from the business to support the debt service and the property taxes and insurance on the building.
Okay. The next question I've got kind of comes back to something that Steve was talking about you needing 3 years of P&L. So when it comes to getting a loan to buy a business, how are you supposed to show 3+ years of P&L if you don't own a business yet, which is the reason you're getting the loan?
Oh, it's 3 years of the existing business that you're buying.
Right. So.
Yeah, if a business doesn't have 2 to 3 years of profit and loss statement showing profitability, it doesn't qualify for an SBA loan.
Right. And there's two processes of the SBA. First of all, the business has to get approved for the SBA, and we usually get a listing. We get a pre-approved when we get the listing, so we mark it as pre-approved, and then the buyer has to be approved by SBA. So there's a two approval process situation there.
So,
Right.
so
I
know
saw
a
a
couple of people have
question,
been,
Alan, about franchises
yeah.
that I really want to kind of respond to that one because we had an SBDC client that had purchased a franchise that was fairly new, and she had a terrible problem with her build out with her contractor, and it really held her up, and it really, really messed up her situation. And halfway through, just as she was about to get open, her franchise went bankrupt. So I think that what you really need to do if you're trying to buy a franchise right now is just really, really make sure that that they're long-standing, you know, that they're not a new franchise, that they're not a startup, that they've got some history. It's really important right now.
So a couple of questions around what's going to be happening with rent. So one was about options and extension. Louise, you said the terms would reset to quote market rate. Does that mean if there's an extension that, during the post-COVID around now, is that would it reset to a potentially lower than previous normally?
I don't understand the question.
So let's say if they have an option, and you said those options and extensions normally reset to market rate.
An option is different from an extension.
Okay.
Options
about both of them.
So options are things, and they can be bought and sold. An option usually belongs to the buyer. It could be like a 5-year option, and I can either exercise it or not exercise it. That's my right. Okay. An extension would be adding on, and they usually, if there's no other language around them, they usually, if they're on the back end of a lease, there's usually a jump to market rate. From whatever the lease was, it will adjust to market rent. When you're doing an extension is just adding, 5 years onto an existing lease. And if the language in the lease is, each year this, rent adjusts CPI or 5%, that's usually what you get. You just get it continuing as the lease did, but there would be an addendum adding additional time on there. That's the difference.
But with the option where it's going to reset to market rate, if the market rate, and you're saying the market rates have dropped significantly in many places,
it'll be down. It'll go down.
It could go down. Okay.
Yeah. Mm-hmm.
And then I think someone's asking us to guess the future. I said if they have the option to renew my lease next March, what are the chances of the new terms to reset to a lower market rate?
Oh, I would wait. It'll go.
They usually have a 6-month window to exercise, right? So March, you got to exercise by usually, October or so, right?
You usually have to notify them 6 months in advance.
You want to exercise the option and then just play out the, what's happening in the economy and capitalize on what's most advantageous to you to get the best, deal you can get. There's a good chance rents are going to go down from what they are now.
Yeah. Do you want to stay in is the question. If you want to stay in, then now's a great time to really, you could step in now and you could negotiate something really great for yourself, or you can wait and you can see what the market holds. But what I'm seeing right now, pretty much across the board in the Bay Area, is rents are down about 30 to 40%. Are you seeing that, Steve?
I'm not seeing that. No, I'm seeing drops, but not quite that much. No. I can't really quantify it.
I'm seeing about, I would say 30% to be conservative.
So we had a question from Jax around, and this is, it's about the SBA, but I think it's more than that. So it says, does the SBA, quote, read between the lines on a seller's business tax return? I mean, it seems we're trained to take every deduction possible. When it's time to sell, the tax return may not reflect all the perks of a business. That was something I think you were talking about earlier on, Steve. Does the SBA take this into consideration?
SBA has a standard formula for recasting. They will do an SD analysis, but they won't add all the things that I discussed. They basically add back one working owner salary, depreciation, and interest, and that's it. They don't add back the cars and health insurance and non-reoccurring events and capitalizing versus expensing, remodeling costs, etc. They just do basically one worker's owner's salary and payroll taxes, depreciation and interest. Those are the add backs they add onto the net income of a tax return.
But it's also, you have to, it's not just the SBA, you have to convince it's your lender as well. And that's the SBA conversation.
Yeah, well, when you're dealing with the lender to deal with the SBA.
Yeah. And then we got time probably for one more. So I guess towards people who are looking to buy, it says somebody was asking if when pre-qualifying a buyer, what do you want to see? Is it liquid cash like a savings account or brokerage account that comes up to that amount, or do you verify the amount of the account actually belongs to the buyer and is not just deposited short term?
We like to see money. Where's the beef? I mean, bank statements or security statements, wherever the liquidity is going to come from. That's what typically, we'd like to see. Where's the cash coming from? It may be a refi, and again, that's iffy because the refi that may not happen. So really want to see bank statements supporting where the liquid cash is.
Yeah, from a buyer, what I want to see is they've got enough cash to close their portion of the deal, plus escrow fees. That's what I'm looking for. If I represent the seller, obviously. And then I want to make sure they show up well enough to be able to get approved by the landlord. Do they have as much experience as the seller? Are they as financially sound as the seller was when they took over? And if there's discrepancies there, then we need to, what we call, package them better. They might not be as experienced, but they've got a very, very exciting concept, and that's what I'm going to pitch, or they've got a following, or they might be a startup. I mean, some landlords won't accept a startup at all. They'll just say, no, I need somebody with experience. So sometimes you have to really, and again, that's where the value of your broker comes in. Your broker speaks landlords speak. They know what the landlords are looking for, and they know what to focus on. So,
yeah, I mean, the mentality of a landlord pre-COVID is that if it's an independent, non-franchise, non-chain restaurant, without a question, they want to see 3 to 5 years ownership or management experience of a restaurant. And they don't care how much cash you have. They want to make sure you can walk your talk. You run a business, a successful restaurant. In some cases, I've had landlords won't do a lease with somebody unless they have an existing restaurant, and they go eat in the restaurant, experience the restaurant, see the service level, the maintenance level, to make sure they really walk their talk firsthand. There are some landlords like that, and I'm speaking from the perspective of being a restaurant landlord.
Yeah,
well, I'm very much aware of the time, so
I'm going to stay on and answer the questions just so that we have it in the recording. If you have to go, Alan, I completely understand.
Thank you, Alan.
Thank you. It's great. Thank you. Question here from Ramesh. How early before lease term expires should a landlord disclose the terms of the option? And that's a great question, because there's very, very specific language that when I represent the buyer, and it's not necessarily boilerplate language. So what should happen, I've read some leases where the landlord gets to decide everything, and it's like, no, that's a deal breaker. So what usually happens in trying to figure out what market rent is that the landlord will have produce a broker, and the tenant will choose a broker, and the two brokers will get together and compare comps, and they will come up with what market rent is, or market rate, right? And that's usually the language. There's very, very specific language, additional language around that, which is again why you should contact your broker or an attorney around that. So
if I could add something to that. Yeah. Normal, if the mechanism for determining fair market rent is the broker method, there's usually language that says that the two brokers, if the landlord's broker and the tenant's broker can't agree, then the two brokers, a third broker, and the third broker determines what the fair market rent will be.
Yeah. But you want to make sure that that language is in there, and not just, you know, I've seen a lease recently where it says the landlord gets to choose what market rent is. And that's obviously not what you want, right? You have to be careful around that. And a lot of times in leases, it's not the language that's in there that you actually have to analyze. It's the language that's not in there that should be in there. And that's why you need the attorney. When applying for SBA loan for existing business, but you want to change the concept, what is the best strategy to present this info to SBA? Want to take that one, Steve?
Yeah, well, if you're talking about a non-franchise, a startup from scratch, the lender's going to be looking very heavily on what your background has been, what the applicant's background has been in terms of startup other restaurants. Are they actually existing? Are they operating? Can they go and see them and check on them? You're going to have to substantiate significantly what your past background has been in order to get the support of a SBA lender to do a loan on a business. But it is doable, and I've seen them done. Again, upon the quality and quantity of the experience that the applicant has had.
And that should be shown on your business plan and your financials as well, you know, I mean, and your team that you're going to put together. Maybe you're missing some of the, you know, the checks, but maybe you've got other members of your team that are partners that kind of fill in the gap. So it's really important to present the whole picture. Going back to the business valuation section, Bob wants to know, in a valuation based on adjusted net cash flow, what discount multiplier do you use for calculating the value of the business?
Discounted cash flow, I don't quite understand the question. You use a multiple of the SDE, and again, we take 3 years, assuming there's no extraordinary situations like COVID or the Great Recession, et cetera, and that determines what the average weighted SDE is, and take a multiple of, usually is around 2.2. Now, multiples will vary. If it's a franchise, each franchise has their own multiple. Like McDonald's, they don't use multiples. They sell for a % of gross sales, for example, or a very successful franchise may use a 4 or 5 multiple. So it's just the independent, non-franchise, non-chain is higher risk, lower multiple. That's how it works. And the 2.2, it varies between 2 to 2.5. If it's a bar that's been around for a long time and they've had a steady history of earnings and history, that will frequently sell for a 3 multiplier. So it's not fast 2.2. It really depends upon, you know, length of how long it's been in business, the steadiness of its earnings and sales, etc.
It says, Connie says, it sounded to me like the landlord has so much power over the buyer and seller. Why? And that's actually a really, really great question, because, you know, up front in the beginning of a deal, you're negotiating and it's buyer and seller. But at the end of the day, how many deals do we lose because the landlord is a stickler, or, you know, the landlord is very, very much a part of the deal in the sense that they're not necessarily are allowed to be privy to the sales price. But you know, it's their location, and so they have to approve. And I, you know, you really have to, before you get in front of a landlord, you really want to, you know, you want to present well. You want to have your business plan, your financials, you know, you want to have your financial statement, your credit. You want to be packaged and ready to go. You want to come across as, you know, as professional and ready. Right. You know, the landlords, there's different personalities out there, and there's some landlords that are more lenient towards restaurateurs or have been restaurateurs, you know, and so they're willing to take a chance on a startup. Others won't. What do you think about that question, Steve?
I think, you know, being a restaurant landlord, I even have more stringent criteria for a restaurant tenant, because I know the failure rate, you know, and as Louise has mentioned, it's significant. You know, independent, non-franchise, non-chain failure rate is like 50% the first 3 years, 70, 80% the first 5 years. It's horrendous. So, you know, if you have an independent, non-franchise tenant, your risk factor as a landlord that they're going to fail is very great, which means you're going to have loss of rent. You're going to have, you know, possibly a bankruptcy. I had a tenant one time that I had to get a relief estate from the bankruptcy court. It cost my partnership $500,000 to get the new tenant up and running, giving him free rent, contributions to land tenant improvements, having to pay part of a commission, having to pay seismic upgrades to the building, etc. Very costly. So, you know, and it's the landlord's property, and it's property which facilitates making that restaurant happen. I mean, as far as the location, providing the conduit for that restaurant to be there. So that's part of the rationale, I think, why landlords control the game. It's their building, so they own the building. So, but as what Louise mentioned before, if you can own your own building, that's wonderful. Then you can control your destiny much better.
Right, great comments. If I am building my bakery in a new city, prior my bakery brand was operating 8 years in the old prior location, how long do I need to be operating before I can sell the brand? We haven't discussed selling a brand in the newly built bakery. So that's a little bit of are you talking about selling the business or selling the brand? I have a whole separate class on selling the brand. So I'm not sure we can really answer that one here, Sonia, but if you reach out to me, I can give you some information on that and how I would approach it. We've got Stephen who says, I want to listen to the rest of what Steve wants to say before the lockup. A lockup. Do you have a particular question, Stephen? I'm just gonna ignore that one. If asset sale, do I still need to disclose tax return and financials? Not necessarily. How do you do it, Steve?
Well, that's true. However, you know, in order for the buyer to have a comfort level that you've actually obtained those sales, they're going to want to at least see some history documented of your sales, not just your self-generated P&L that you do on QuickBooks, but, you know, sales tax returns to support the sales level that they're going to use as a basis for their projections for, you know, doing a pro forma for their new concept. So they want to have some substantiation of sales. They also want to see what costs are going to be applicable to them documented, such as rent, utilities, insurance, those kind of costs that will be applicable to them, even in their new concept. Their food and labor costs and other controllable costs will vary, but they do want to substantiate the costs I just mentioned and the sales I indicated through sales tax returns. Yes.
Right. And here's the thing. I mean, you know, Steve.
I'm sorry, yeah. Before you do that, let me just preface that. If somebody's going to go in there doing a totally different concept, they just really want the location, and they're paying the key money just because they want the location, then they're not going to be as concerned about, you know, substantiating sales or the things that I talked about. They have their own formula, and they just, so in that case, you know, you can get away with doing an asset sale without the things I previously mentioned.
Right. And it's a generational thing too, because I mean, Steve and I's and Steve's a bit more analytical, but I've worked with people my age and they're the old school restaurateurs and they go, yeah, I'll take it, you know, and that you come with a millennial and you're asking a millennial to open up their wallet and spend, you know, $200,000. People aren't just going to necessarily give you that. They're going to want to see, you know, some information on that. And so you kind of want to, you know, really think about, if you're a seller, put yourself in the buyer's shoes and try to, you know, understand what it is that they're trying to see and to justify that, you know. So, and again, it's a little bit case by case. So, Maya wants to know, Steve, how does rent affect the valuation of business? You mentioned sales as a very rough criteria. What about rent? That's a great question.
Yeah. Well, generally speaking, occupancy costs, which is a base rent, plus if you have to pay a double net, you know, single net, double net, or triple net, which is basically real estate taxes, insurance on the building, or if you're in an office building or a shopping center, triple net costs, CAM costs, which are common area maintenance costs, paying a pro rata share of the utilities of the shop, of the building, security, landscaping, parking, common area utilities, etc. So generally speaking, it should be really more than 8%, all those together, if you want to get a reasonable return on, make a reasonable profit in the business. So that's usually the parameter. Now, going back 10 years ago, I would say that number should be closer to 6%. But realistically, in the Bay Area, in particular, where occupancy costs have gotten so out of hand, most people are lucky to obtain 8%. Once they start getting over 8%, their margins are going to are hammered even that much more, because it's so expensive to do business in this area because of not only high occupancy costs, but operating costs, labor costs. The governor said he's raising minimum wage, even because of COVID. People need to have a reasonable standard of living, and I don't argue that. And so you got all these other, very escalating costs, which you can't pass off to the customer, and therefore the margins keep getting crammed. So you get that rent occupancy cost out of line, above that 8%, you're going to have negligible or no profits.
Yeah, and that's a great point. And I think, especially during COVID, I think a lot of us are kind of, having to have those conversations with landlords and get realistic on dropping their rents right now, because in some cases the revenues are zero. And so how do we get creative and put our heads together and kind of make this transaction happen? So it's definitely challenging. If anybody's still on and they want their questions answered, please put them in the question and answers. I can't do it from the chat because I can't manage them properly from there. So I've got one final question by the looks of it, from Ramesh. He says, if I want to exit my business, which is profitable and has multi-year record of success, isn't it better to sell and get some money back before lease term expires rather than letting the lease expire and walk away at the end of the lease term? Yes, absolutely. Second part. Or are there cases when landlord pays for a portion of the investment that I made to make improvements, since they can get key money from a new tenant since the space is now ready to open for business? That's a great question, Ramesh. And yes, a lot of that will depend on the landlord and how kind of creative. I've actually negotiated that on behalf of one of my clients, that there was a build out almost completely done, and all of a sudden an investor pulled out and there was no way to get the doors open. And so, we negotiated with the landlord, because they had put a good portion of money into that space, and we had a friendly landlord that was willing to, allow the tenant to walk away with some dignity, and gave him some money in order to be able to do that. But they're not all like that. So, if you've got a good landlord and you think that they'll work with you, I think that you'll probably get less from your landlord than you would if you went through the process of a sale. What are your thoughts on that, Steve?
I agree. Yeah. Most realistic monetary items are going to come from the sale of the business, not from the landlord. If the landlord really wants the tenant badly, a new tenant, he may give him some free rent, may give him some contributions to tenant improvements. That's typical. And maybe gave him some reduced rent for a while, but Charlie's not going to give him a lump sum of money that he would get on the sale of a business.
Right, great. Well, I think that's it. We've got some people thanking us in the chat, and I really appreciate your time today, Steve. And we got most of it.
Yeah, and again, just to repeat for those people on the line, because since we covered quite a few things just on a cursory basis, if you want to reach me, it's steve@restaurantrealty.com. And I'll even give you my cell phone if you'd like. It's 415-720-5468. And I'll be happy to answer any questions you have or give you more in-depth information on some of the stuff we sort of touched on a very, minimal basis. And Louise, thank you for letting me participate. I've enjoyed it.
You're welcome. Always a pleasure, Steve. I still to this day learn so much from you. I put that in the chat. So Steve's email address and his phone number is in the chat. If you need to reach out to me, if you're an SBDC client and need some questions, it's Dawson@norcalsbdc.org. I actually, before I sign off, I see Sharon Roberts' hand up. I'm sorry, Sharon, just reach out to us, and we'll try to get your questions answered. I think I have stolen enough of Steve's time, and I know he's super, super busy. So thanks everybody for attending and sticking it with us, late and going late with us. We appreciate it. And for all you restaurateurs, trying to hang in there, we're here for you. So
stay healthy.
Yeah.
Their family, that's most important. Stay healthy.
Yeah. Thanks everybody. Bye. Have a great afternoon.
Bye-bye.